Hi, friends. Thank you so much for joining Masterstroke. And today we have a special guest on our show, Kunal Sangohi from Aditya Birla Mutual Fund. Hi, Kunal. How are you?
Good. Thank you so much. Thanks for having me here.
Wonderful to have you. And friends, may I request you to please give a round of applause and welcome Kunal in the chat box so that he feel that
Thank you, everyone. Hi.
he's here. Thank you so much because we people speak to the wall. We don't know, who is listening and not. And so it's very important to have some kind of, energy in the room. Thank you so much, people. Thank you so much. And please stay. We'll have some wonderful conversation with Kunal. So, Kunal,
Yes,
Birla is back, isn't it? Birla Mutual Fund went through a rough patch and now their schemes are doing quite well. How did
yes.
you do this? What is the secret sauce that you applied?
So I think, every AMC goes through various patches. I think, so we also had a great run from 2012 to 2018. Then, there was this phase post 2018 where, it was basically a lot of schemes actually did not do well. So we are very good in thematic overall, if you see. So various sectoral funds, thematic funds, we've done very well there, be it a PSU equity, a Digital India, or a Gen Next, all of, such funds. But there are quite a few changes that we've done. We've gone through. So to solve any particular problem, it is important that what caused the problem. So in the say 1.5 years, 2 years back, actually we sat down and actually we've done a lot of analysis of the last say 15 years in terms of how what we did. So any AMC or there is a 80/20 rule, right? 80/20 rule. So for any AMC, 80% of the AUM is usually invested in 20% of the stocks.
Yes.
So for us also, we have a universe of about 500 odd stocks as a overall, but we used to own say 350, 360 unique stocks as a at a overall fund house level. Now we looked at so top 75, 80 stocks, which is like 20% of 350, is where our 80% of the investments were, the AUM was invested. Now, we looked at various history and like the cricket analogy, where basically you have the opening batsmen, then you have the middle order, and then you have the tail enders. So all the nifty stocks, we considering that as a top order. And that is something that gives the stability, and those are the, it opens the innings and like the top, opening batsman basically just faces and goes through the phase of the tough bowlers. And that is what that phase is. The next is the middle order, which actually stabilizes and builds the innings, right? Say from 15th over to the 35th over in a one-day match. Usually that is what the middle order, their job is to take ones and twos and, continue to give that, build that inning. And the tail ender is that, in whatever last few overs, basically you hit maximum and that create. So similarly over here in the fund house level, the Nifty stocks, which is top 50 stocks. Then there is the next 75, which we are calling as a core 75. And that is where basically, that is what we looked at in the last 12 years. So Nifty, we were doing very well in terms of say a 53, 54% of the AUM was invested there. In 2012 to 2018 period, this middle order, which did very well for us, was around 36% of the total AUM. That over a period of time, say from 2018 to 2021, 22, that middle order percentage had fallen in, so this is basically we are analyzing what had happened and how we are trying to correct it. So that had fallen from 36% to 21. Now, mind you that this is the post Nifty stocks, the next 75 stocks, which generate a good alpha and gives, these are like large caps again, and say larger mid caps. Those generate a good alpha and create a good, stability to the portfolio, balances the portfolio. And the next tail enders, what our AMC's holdings basically increased in those tail enders. Now, tail enders also come with that specific risk. While we did very well from a alpha generation point of view there, but the middle order, which is the core 75, that was one where we had to bring that again, that alpha gen. So I think that was the key that we discovered, that was the issue. And hence there has been a lot of changes that have happened. So number one, in terms of the changes, is the team itself, right? So many of us, so just giving my background, I joined Aditya Birla AMC in 2012. I joined as a tech analyst, senior analyst, and over a period of time, as I handled more, as I handled my responsibility and added responsibility, I got fund management responsibility. I started managing the Digital India Fund from 2014. So almost 10 years of track record on that fund. And since last few years, like 4 5 years, been added more fund management responsibilities. Uh, so one is that me. Then there are 3 4 other analysts like me, senior analysts, who now become fund manager. Yeah. So they basically have been given more responsibility now. That is one big change that has happened. And we have that, hunger and passion, as we say, in terms of, trying to build our own track record in terms of fund management. So that is
Correct.
number one. Number two is that, below us, there has been a lot of hiring at a senior analyst level. And then there are junior analysts, further junior analysts who we've added, who are actually, on ground, who help us in terms of channel checks. So say, for example, if we are doing a research on quick commerce. So these research associates actually go to a Zepto dark store, check how, things work, how the order processing happens. Similarly, it could be a retail store where they are looking at how the customers are, some feedback with regards to particular industry, particular stores, and we try and connect those dots. So one is, the second is that these team additions. The third is, last year we have a new head of equity and a co-CIO, Mr. Harish Krishnan, who has joined us from Kotak. He was there for about 17 years, and he's very strong on the quant and the overall data analytics side. So with that, we've strengthened our processes significantly. So every Thursday we have a blackout day where there is no external meeting, only internal meeting with the whole investment team, which basically we threadbare discuss a particular sector or a particular company, and for which we have a tear sheet. So tear sheet meaning the details of the company, where basically we highlight that how can we imagine. So the analyst who's working on that, he will present that tear sheet. He will respond to questions such as whether the stock can double in the next 3 years. Why do you think the stock will double? What Who is the key management and what they are doing in terms of strategy, which will lead to the stock being doubling, or whatever target that he has. Then what are the risks if these things do not happen? What is the kind of downside? So the whole reimagining process has been put in place. Similarly, if a new sector, be it a paint sector or a cement sector, so then it is discussed threadbare, presented to the whole team of fund manager and analyst, and he's extremely challenged, and the detailed discussions happen. So that is bringing that depth and conviction to build large positions in those core 75 stocks, right? The next, outside of next 50. So I think that is one of the key things. So like, if I were to give an example, so many of these stocks, so now in the equity fact sheet we have a core 75 stock list also. So something like, say, a Whirlpool, we did our first largest single day big trade in in uh, in Whirlpool at one point in time, given that once we had presented in a blackout day, so all fund managers got conviction. We did almost like bought almost 600 crore worth of stock in at a time. That was when the parent was selling at around 1250, 1260, and in 6 7 months time frame, we've seen stock moving from 12 almost 1300 to 2000. Now maybe it is 1800. Similarly, be it, there are enough examples how we build bigger and take bigger and bolder bets. So I think that is one of the key things that is started to work out, and try to reduce some of the tail position where there is a risk associated. Because what happens is that many a times there are enough smaller positions which are slightly reducing, slightly, dragging the alpha on the portfolio. Okay. So important to reduce the tail and build that core 75. And I think, that is what is extremely working well. I think, to summarize, basically, this has been the key changes that we've worked
Nice.
on. Yeah.
So, Kunal, markets went down to 77,000 almost. Now it's almost around 82,000. Is the worst over? What's your quick answer? Should we start investing, or you still expect the worst is still to come?
Uh, See, let's take a step back, look at where markets were a year back. Markets have delivered 22% return, right, overall, and there was a 7 to 8% kind of a drawdown recently. Now it has gone up slightly. I think in the say last 2 months, the kind of selling intensity by the FIIs. FII sold almost 1,60,000 crore worth of stock in the October and November months. Now, despite that huge selling, markets went down only 7-8%. Some of the sectors corrected far more, 15%, 18%, and some of the small cap, mid cap corrected like 20 to 30% range. In my view, I think, the last 1 year, markets had till until September, markets had unidirectionally continued to move up. And, this gives us opportunity to actually do a lot of better stock selection in a way that, some of the stocks that we would have liked, but the price was not in favor. I think this is bringing uh, you know,
Sanity in the market.
some valuation to actually realistic level, and helps in terms of right portfolio, right churn within the portfolio, and stock selection. So I think in a way it is a good that this correction has happened, maybe. And now let's look at why this correction also has happened. So if you look at since April May timeframe is where the slowdown started particularly, and that was driven by slowdown was driven by, say, stalling on the government side, on the infrastructure side, because there was central elections in May June timeframe, May this year, and then there were a couple of state elections. So recently Maharashtra elections concluded. So all that was one of the big impacts which has led to. So if you look at the overall infrastructure capex spent by government, out of the total, say, 11 lakh crore of the full year budget, only 40% of the capex has been spent in the first 7 months. So that slowdown has actually flown through toward into the economy. And hence we also saw GDP number in the September quarter being 5.4, first time less than 6% in many years. So I think this is a transitory phase, maybe the data points. So, but the thing is that the worst in terms of the decline, no, is over, but it will start reflecting in those high frequency numbers from Feb March timeframe. And hence I would say that December quarter, December months, maybe whatever recent uptick that we've seen in market, that's also because of, say, FII selling not being there. So once January some results are declared, there might be some earnings decline or downgrades, which market should be in that 5% minus kind of a range. So that gives a good opportunity. But I think by March time, post March time frame, I think things should start moving positively. Hence, I would say that use this next 3 months as a good opportunity to actually recalibrate the portfolio and add to weightages in terms of
All
the.
right, all right. So, Kunal, recently I happened to meet, and this is a very important question for the participants. I think they will like this question, and your answer will be appreciated. I recently met two, three international investors, my clients, friends, relatives, and because this is a marriage season, and you meet up a lot of people, and during the course of discussion, they were saying, "Why India? The valuations are so high. There are world of opportunities, elsewhere, especially US." With Trump coming, interest rates can come down, taxations are expected to come down. That will flow a lot of money in US, and everybody is gung-ho about US stocks. The US market is selectively not as expensive as India. And at the same time, when I think about this, valuations, for the last 20 years, Indian markets have been overvalued. If I did not invest, then I would have lost this opportunity कि भाई बाजार महंगा है महंगा है महंगा है. So as an investor, I'm confused कि इंडिया की वैल्यूएशंस इतनी रिच है अभी, तो और इंटरनेशनल वैल्यूएशंस इतनी रिच नहीं है, हिस्टोरिकली भी ऐसा रहता है. तो आखिर कब तक ये इंडिया की वैल्यूएशंस इतनी स्ट्रेस्ड रहेंगी, एंड इज इट अ हैबिट आई हैव टू फॉर्म दैट कि नो मैटर व्हाट आई विल इन्वेस्ट इन इंडिया, और शुड इंडियन इन्वेस्टर्स लुक टू डिवर्सिफाई इन अमेरिकन मार्केट्स थ्रू फंड ऑफ फंड्स और डायरेक्ट इन्वेस्टर्स?
Sure, okay. Interesting question. So, see, इंडिया में हमेशा बोला जाता था कि इंडिया सोने की चिड़िया है, राइट, एंड द डेमोग्राफिक डिविडेंड. बट वो क्या था कि मे बी दैट वाज मच अर्लियर देन टाइम फ्रेम. नाउ लेट्स लुक एट व्हाट इज हैपनिंग नाउ. There are very big changes that have happened, and the kind of GDP per capita also where we have reached. I think that is a very important juncture. So we are at a 3,000 $2,500 kind of a GDP per capita. Now, usually, all your basic needs in terms of roti, kapda, makan, if you look at broadly, at 1,500, $1,800, is something that, it gets achieved. And then anything, for further is all what consumption is getting, consumption gets driven. So when you look at GDP, 2,500 at a pan-India level, there is a Mumbai, Delhi, where the GDP per capita is far higher. So Mumbai will be at $3,800. Delhi is about $4,500, and the rest of some of the other states are much lower, which will be like 1,500 to 1,800. But that is abroad. Now we are moving from that and moving from that upwards. And as you move upwards, there is a huge, say, below. So there is a lower class, there is a middle class, lower middle class, then there is upper middle class. So there is a pyramid. The lower income category is, few of them is moving to the
Yeah.
lower middle class, and lower middle class is moving to upper middle class in the next 10 years time frame. Now, and that is where the maximum population is. So almost 50, 60 crore, 500, 600 million people in the next 10 years will move in that upper bracket. That is going to create a huge consumption overall, right? And so it could be consumption on the discretionary side, consumption on staples, and more aspirations. We are seeing that all the online, say, be it a Flipkart, in Amazon, significant demand is coming from tier 3, tier 4 cities. So the aspirations are rising, and there is a huge demand wave. So I think we are at a cusp of a journey. So that is one angle. Second angle is, if you look at what is happening from a government side. So also government is significantly driving the policy framework, which is far more stable versus the earlier regime, far more stable. They are spending themselves significantly. So last 7, 8 years, so significant infrastructure spending. So maybe we are at a point in time where China was in 1990s, where for the next 15 years, China grew at a very accelerated pace. Now, as Indians, if we do not believe in that phase, I think we are losing on a big
You
decade,
mean
big
to say that
opportunity.
India can grow faster at 7% in the next 10 years?
Yes, yes. And I think, that is exactly the point that, if so, we will never realize that this was that decade which actually grew much faster, because it's only, as we passed through, when we are in that time frame,
Yeah, I
we
agree.
will feel that, सब कुछ same है, कुछ change नहीं हो रहा है. But there is a lot which is changing. Look at the way SIP culture has grown, right? 2, 3 years back, SIP book would have been like 8,000, 9,000 crore. Look at now the way growth, the whole digital India. Okay, there is a big stack of digital India, and government's push toward digital economy has been significant. We cannot ignore that change. Today in India, every second. So I think I'm again saying every second in India, 5,500 UPI transactions happen every second. So, and that is a flawless execution. Every transaction has continued. So plus the KYC through the Aadhaar. So the digital economy is creating the whole significant efficiency in the economy. You look at citizen services, be it, passport, in a week's time frame, you get the passport. Earlier, you would not have thought about it. Similarly, income tax return processing. What has changed? You look at last 10 years before and now, the income tax processing also happens in the three in 1 week itself. Refunds do not take that much time. You do not have to follow up. So there is a big change that is happening. So we should be part of that change. And I think, I would say that if we are not investing in India at this point in time, I think we are going to miss a big opportunity, wealth creation opportunity. And hence, I would be personally extremely all in on equities for the next 10 years.
Fantastic. So am I, and I think most of our distributor friends and investors. Um, Moving on, Kunal, Birla is launching another fund, Birla Conglomerate Fund.
Yeah.
And I want to play the devil's role, to be very honest. And I'm going to ask you, what is so great about this conglomerate fund? Why should I give you my money? What return can I expect into this fund? And why is Birla launching this fund?
Okay. Okay, sure. So what I'll do, I'll share one slide
Okay.
which will show, what is very different and why. Okay, let me share it.
Yeah, you have the rights.
Okay.
And friends, if you have any question about Birla Conglomerate Fund or anything specific about Birla Mutual Fund, please go ahead and write in the Q&A box or the chat box. I will pick up some of the questions.
So one is, when we think about conglomerates, so these are the business groups, industry groups, which are multi-generational, are multi-decades, and they have incubated many businesses. Usually they use the cash flows of, a particular business, which is much more profitable. You invest that profit into incubating new business, and that creates value. Um, you're in short, what we are showing is that, these are the businesses like, a father or a grandfather or great grandfather, set up that business as a small promoter driven family owned business, and over a period of time it has diversified. Matlab, then there is a current promoter who's running, and then, the next generation who's coming on board, and he's investing in the new areas, bringing new perspectives. So these are multi decades. कल थे आज है और कल रहेंगे is what we are showing here. But so this is just about, what are conglomerates. And when we think about conglomerates, we always just think about, few names that, be it, Tata's, the Aditya Birla group, then the Reliance as a Ambani group and a Adani group, Mahindra's, Jindal's, few names come to us. What we are defining conglomerates is that any promoter group who has two or more listed companies and both are in different industries. That is a conglomerate. That way, we are identifying about 35 business groups in India who have around 170 listed companies. So, for example, Tata as a group itself has 30 listed companies. So, when you add up all the listed companies, basically it is about 170 odd listed companies that this group, and they are spending significantly on building India in terms of the capex. These are all heavy industries. Uh, So on the, and the products of all these, conglomerates is what it touches billions of life. Everyone is quite familiar, be it, food, lifestyle, living products. All across, we are using products of these conglomerates.
So basically,
So,
you're talking about large cap. The strategy is going to be pro large caps. Do you mean to say that?
so I will just touch on that. It will be pro large caps, but there is a good amount of mid caps and small caps as well. Um, so here, basically, we're saying why now. Okay, so that on this slide, basically, this is one of the important slides. If I can just take 5 minutes to take through this slide. Here, this is the capital expenditure by the top 1,000 listed companies in India. This is the gray bar. So in short, last 3 years, there is a significant increase in the capex driven by, one is the government's push to drive a manufacturing economy. More manufacturing should happen. So more capex has to happen. That is happening. And which is why government has come out with PLI schemes, different PLI schemes. The second is that, post-COVID, global companies are accepting India's products because they want to diversify the supply chain. Hence, there is an export opportunity, which is why also, this high capex. And if you look at on this bar, which is the gray bar, the red bar is these 170 companies out of 1,000 companies, which are doing almost 50% of the capex, which means these business groups, these industrialist group is significantly investing in the capex when you compare that. And capex is nothing but money which you are investing now, which will yield in future the revenues and profits out of it.
Okay.
So the growth is going to happen much more for this as a group. And if you remember in 2000, say 2002 to 2008, there was a big bull market in India, right? In this market phase, the companies, so this is on the right side, this chart here basically, which again, that time the conglomerate spent a lot of capex versus the others. That time, all the sectors which were in, say, by the conglomerates, which was like more so infrastructure, power, which sectors did well in that bull market? Infrastructure, power, real estate, capital goods, industrials. which are all called heavy industries, heavy asset heavy industries. Those did well. Now, in the phase which started in 2022, we feel that again in that phase, a significant capex is increasing last 3 years, as we saw on the left chart. And as these capex is done much more by these industrialist groups, this will be rewarded far more by the market. Hence, this is a very good time for this theme to start working out for the next 3 to 5 years very easily, and probably 10 years on a longer term. So that's the first thing. Second, and if you look at these major industry groups, business groups, they are spending a lot in all the sunrise sectors, be it semiconductors, green energy, electric vehicles. Most of the spaces, they are there and investing in the next at least two of the five sunrise sectors, which is nothing but is going to yield growth. Now, this is one, how conglomerates actually have a business incubation cycle. They incubate a new business, bring it to scale, then demerge it and create value out of it. And this is an example we've put out of the Bajaj group, where from Bajaj Auto was first company from where actually Bajaj Auto Finance came out initially, which is now that time they were doing only auto finance, but now they are doing whole consumer finance. So this Bajaj Auto is what the current Bajaj Finance is. Earlier it was called Bajaj Auto Finance. And the Bajaj Auto in 2008 demerged into three entities, which was Bajaj Holdings, Bajaj Finserv, and the current Bajaj Auto, which is there. From Bajaj Finserv, which is an insurance business, that is a parent of Bajaj Finance. And from Bajaj Finance, another business came out, which was Bajaj Housing Finance, which was, recently 3 months back, the IPO came. So this is the pattern, and this creates value over a period of time. Similarly, be it a Adani Group, where from Adani Enterprises, Adani Ports first came out, then Adani Power came out, then Adani Renewables came out. Now there is a big Adani Airports business, which is part of that. So that is the incubation cycle. Now coming to, what is unique about this fund? Yeah, so this slide tells 4 unique factors, particularly about the fund. So one is that as a business or India industrialist fund, this is first of its category. There is no category as such. There is no fund. So one is, if you have to play the India's growth story, these are the industrialists on whom you have to back. These are the business groups on whom you're backing. So that is a first in terms of overall as a exposure. Second, very important thing, as I told, that how we are defining conglomerates is that it has to be a promoter driven business and has to have two listed companies and both different sectors. So banks are professionally run, right? So banks do not qualify here. So if you look at any other flexi cap fund or a multi cap fund, 30% of the portfolio will be banks and banks plus PSUs as a whole, right? Now that exposure will not be here. So, banks are not there, PSUs are not there, then MNCs, because they are foreign parents, they are not going to be there. And this is the most unique factor that, 30% of the portfolio will be very different, and it is invested in the whole industrialist group or the business group as a whole. The third is that all these conglomerates, many of these conglomerates have a particular holding company which holds stake in all the group companies. For example, if you look at Aditya Birla Group itself, Grasim is a company which holds stake in Hindalco, which holds stake in Ultratech Cement, which holds stake in Aditya Birla Capital, right? And then there are other, like Bajaj Holdings we talked about. Bajaj Holdings has stake in, the Bajaj Group companies, but they do not have operating business in itself. These holding companies, they trade at a significant discount to the inherent value of the stake of the companies. So there will be exposure in this fund to the holding companies to a smaller extent, but in phases, this outperforms significantly. There is a value unlocking opportunity that is there. So that will be part of this. And the fourth being that it will be an actively managed fund, not a passive fund. So I think these are 4 unique factors. And when you look at, overall theme as a whole, conglomerates, they have a better access to capital because of the existing business. A lot of cash flow is there of the existing business, plus their ability to raise capital outside in terms of debt capital or equity capital is much stronger. So if Tata Group goes to raise capital outside, their cost of capital will be lower than India government's cost of capital. And that is a significant, because the lower the cost of capital, higher is your return on investment capital. So that is one. Second is, capex. These industrialists, they are at the forefront, better place to do capex. They have a good group. So, diversified. They are doing almost 50% of the capex of the top 1,000 companies, which is a very significant number, which is a future growth and cash flow. So that is going to be there. Now, this fund will have a very diversified also. There are like 22 different sectors, but this has like, if you look at industries, fairly diversified. Over a period of time, these business groups have emerged in terms of the governance and ESG practices. And that's why that also becomes a differentiator. And last and not the least is that it's a multi-generational and multi-decade. It has been there for multi-decades. So they have gone through the business ups and down cycle. तो उसने तेजी का भी मार्केट देखा है, बिजनेस में मंदी का भी मार्केट देखा है, और वो दे हैव सर्वाइव. तो कंपनीज वेयर बेसिकली दे हैव सर्वाइव. तो ऐसा है कि वो ग्रुप रहेगा. ऐसा नहीं है कि ग्रुप में कुछ इश्यूज आएगा या उड़ जाएगा ग्रुप, राइट? सो दे हैव सर्वाइव एंड दे हैव ग्रोन फ्रॉम स्ट्रेंथ टू स्ट्रेंथ. तो अगर हमें इंडिया ओवरऑल ग्रोथ खेलना है नेक्स्ट 10 साल, तो ये दैट वे बिकम्स अ वेरी यूनिक ऑफरिंग.
Perfect. So we're running out of time, but I will have some questions again as a devil. Uh, I should invest in this fund as a lump sum or SIP? First question. Second question is that if I don't have funds now, and if you are recommending that Birla has come out with this fund right now, it means that you're recommending to put money in this category. Which category you would think an investor can consider to convert into this kind of category? If the investor is not having money and it looks very promising, this conglomerate fund, from where the investors should take money out? Small cap, mid cap, large cap, flexi cap, quant. I mean, it's a trick question. You can say that.
Difficult. It's a difficult one, because every investor will have a different risk appetite. But let me tell you, this is going to be a slightly aggressive fund, in a way that few sector exposure are not there, but at the same time, this as a group has given back testing. If you look at very strong alpha versus the market, versus a Nifty 200 also, and a Nifty 500 and a Nifty 100 also. So, answer to the first question, I think एक बार आपने initially you also asked about large cap oriented or mid cap, small cap. So let me
Yes.
respond to that also. So what we are thinking is that, so in this group of 170 companies, there are 36 large cap companies that we can invest into. There are 30 mid caps and almost 100 small cap companies. Now this is the universe. We are going to make a portfolio from this of 40 to 50 stocks portfolio.
So let me stop you here. A quick question. What is the benchmark for this fund?
BSE Select Business Group Index.
Okay, okay. And so how many stocks are there in that?
Yeah, so that index has only 7 business groups and 30 stocks.
Okay.
So it is a very concentrated benchmark. So a Reliance
Very good.
Industry itself is a 23% weight. The next heavy weight is a L&T, which is a 13% weight. Then is a TCS, which is a 8% weight. So 4-5 stocks make up almost 50% of the weight in that index, benchmark index. So here what I was saying is, there is a whole bunch of mid cap, small cap to select from. So the way we are thinking is that a 60% large cap and a 40% mid and small cap is what we will make the portfolio. So it will be fairly alpha generating and aggressive in a way, because 40% mid and small cap is a good exposure. So it's more of a multi cap or a flexi cap kind of a category. Flexi has a higher weightage to large cap. Here we'll have a more multi kind of approach.
Okay, so I'll take a few interesting questions from the chat. Virendra is asking, most IPOs like Bajaj, HFL are overvalued. How will they create value for the investors if included in NFO?
Right, in a NFO. Okay, so it's not necessary that we buy at this point in time. So there, as and when the opportunities arise. So say if there are 30 listed companies in the Tata group, we don't want to buy all the 30. We want to take a call on, first of all, which group will do well for the next 3 to 5 years. That is a top-down view. From there, basically we select only those companies which are expected to do well, basis the business and the overall analysis. So business we are going to study, so that is one is a top-down view on a group. Second is a bottom-up study of the company itself. So, business has to be good. The management has to be very strong in terms of because many companies, they are a professional management. So, we look at that execution, strategy and track record. And the third is with regards to the valuations. So valuations are paramount to it. A good business, but valuation high, we do not want to buy. But so whenever the prices are going to be in favor is when we look for it, not necessarily at any price. So that is how I run, the other funds also, be it a pure value fund, the Digital India fund, the focused equity fund.
Okay. Another question, and I will top up this question by Jyoti Trivedi. How many stocks? And if you say that there will be 60, 70 stocks, then is the benchmark correct? Because benchmark, as you said, is heavily skewed towards some conglomerates. What is your answer to that?
Yeah. So the primary benchmark is this BSE Select Business Group Index. The secondary benchmark is Nifty 200. We wanted Nifty 200 as a benchmark. SEBI did not allow it. SEBI gave permission to only put BSE Select Business Group as a primary index.
Okay.
Hence, we have taken that. Given a choice, we would have looked at Nifty 200.
Okay. So from your perspective, I think the investor should choose whatever way he wants. BSC Select is the benchmark, and you will probably relate it more to Nifty 200. Okay,
Nifty
that question is
200.
answered.
Yes.
Venkat Ramana is asking, since ESG score is considered with higher weightage, will you include Adani Group due to governance issue?
So ESG score, basically, it was a theme that, ESG and governance practices have evolved, not their ratings or, those scores. But of course, we have an internal management scorecard. And so Adani Group will definitely be considered. It's not that we are going to ignore. They are the builders of India. And, they are, if you look at the BSE Select Business Group Index, there are 12% weightage to the whole Adani Group overall, okay, in the index. Not that we are going to take that much, we will be, much lower than that. However, there are businesses within the group which are very strong cash flow generating, like a cement business or a ports business, which are good assets. At a right price, they are good investments. Even the incubator business, which is the Adani Enterprises, I think, all said and done, it has created big value over a period of time. So exposure will be taken. Now, how much exposure? Of course, we will be cognizant of the risk. What we internally as a guardrail are saying is that any group will not be more than 25% exposure. But there are groups like this where the volatility is very high. So we look at the volatility of all the group stocks, if they move together up or down together, and the overall beta of that group. If that is very high, then we give a much lower weightage allocation in the portfolio. So that way we will be, very calibrated in the weights that we have in such group.
Devdatta Dhanukar is saying, as a concentrated portfolio, higher risk and volatility.
So concentrated of 40 to 50 stock portfolio will be there. So that will be fairly
They're
diversified.
fairly diversified.
Yeah.
Fairly
So
diversified.
if you look at the 170 universe, okay, 170, how that breaks down into the sector wise, this slide shows that. Here you can see that, there is no big skew on any particular sector within the universe group. So the largest sectors are IT, oil and gas, which are 15%. And then there are, far more smaller ones.
So, Kalpesh is asking interesting question. Most of the fund will have similar businesses group like Reliance, Tata, Adani, Birla. So, what will be the overlap of the conglomerate fund with some of your other funds? Why should an investor look into fund? Will it be more than 50% or less than 50%? What do you think?
It'll be less than that because if you look at the overall, let's bring to this slide. The last two, the conglomerates market cap overall is about 129 lakh crore, which is only 33% of the BSE 500 market cap. So there is one is we are looking at only that 33% of that BSE 500, which is part of, and any which is 170 stocks out of, say, BSE 500 as 500 stocks, right? So we're looking at only that much. So that way it is a very unique portfolio. Second, as I told, banks are usually like, 20 in anywhere between 20 to 30% in normal diversified portfolio. Now, question is, and many of the investors do highlight that, banks have not done anything. Why do you own banks in many of the portfolios? So this portfolio gives that exclusivity of banks, PSUs, MNCs, essentially, and even pharma to a large extent, because only one company qualifies in the group, in the conglomerate. So that is a very active share that you will get. So versus any other benchmark or something, probably there will be an active share of about 60-70%. So that kind of an active share. So it will be far more, a differentiated portfolio.
All right. So I think that should be all. Interesting. It looks very interesting. And I personally attended your entire presentation on the conglomerate funds, a very different strategy from some of the other NFOs. And I think, Birla has huge expectation. All the very best to you, Kunal and Birla Mutual Fund, for the success of this NFO. And I
Thank
hope
you.
this fund makes a lot of money for investors. And thank you so much for being on the show. It was lovely talking to you. Thank you so much.
Thank you so much. My pleasure. Thank you. Bye.
Bye bye. All right.